Welcome back to Global Money Talk live from the New York Stock Exchange. Federal Reserve officials were divided on how much to cut interest rates at their latest meeting in September. Most favored a larger half percentage point cut, and minutes from the meeting revealed that 11 of the 12 members supported the half-point cut. Those in favor revealed it better aligned with inflation and labor market conditions. Some officials had argued for a smaller cut at the July meeting, but found recent data justified the larger reduction. Joining me here at the New York Stock Exchange today is Larry Dyer, a retired managing director with 40 years experience as a fixed income strategist at major Wall Street firms. He is focused on market behavior and economics and joins me to weigh in on the latest Fed minutes released from the Fed. So Larry, great to have you back. Thank you so much for joining me.
Well, thank you for having me.
Well, we got the release of the FOMC meeting minutes from the September meeting yesterday. So what was your take after the release of those minutes?
I think it kind of more confirms the idea that we're looking at the economic projections from the Fed, and it also highlights how much uncertainty there is in the economic outlook. And because there's uncertainty in the economic outlook, there's uncertainty in the Fed guidance on the rate outlook. I did an exercise a number of years ago. I took the different Fed data points and I plotted them to a Taylor rule. And so you get a high and a low Fed funds forecast. There's 100 basis point or more range today in the longer run Fed funds outlook, nearly 100 basis points for 2024. Oh my God, why is it so big? Do these guys get in a meeting and fight like mad because they they think the other guy's really wrong? No, they have different forecasts. So if you quote Keynes, if the facts change, I'll change my view. So they agree on how to respond to growth and inflation for the most part. They disagree on what growth and inflation are going to be. And so I did a few slides to kind of highlight that point. It's kind of fun for us because you can come up and say, hey, everybody else is making a big deal out of the little deal. Go spend more time with your family. Don't worry too much about this. Think about the bigger picture, I think, to come. And that's what I would look to do given the data that we had. There was a move in the market. So I was here a month ago. 10-year note yields are around 3.6%. I'm here today. They're close to 4.1. That's a 50 basis point move. Why did that happen? Well, the lowering of rates was because payrolls were lower than expected. The increase in rates was payrolls are higher than expected. But the question I'd ask is it unusual to have a 30 or 50 basis point move? And the answer I get is no. So what happens next, I think, is the fun component. And we can talk about that.
And Larry, for our viewers out there, I'm sure most are familiar with what's happened when it comes to the Federal Reserve and monetary policy here in the U.S. over the course of the last several years. So obviously we had the pandemic in March of 2020, and here we are October 2024, but heading into this year, there was a lot of anticipation that the Federal Reserve would be cutting rates sooner rather than later, but it took until the September meeting. So that was the first rate cut from the central bank. So can you walk us through where we stand in terms of the economic data that matters?
I think the big data is and remains really inflation. Okay. You have the employment situation and uncertainty with that. And you have, with inflation, the growth rate for the economy. There's a lot of uncertainty about what the long-term growth rate is in the economy. The Fed dot plot or the Fed longer run projections imply 30, 40 basis points of uncertainty. Economic models might imply a 1% plus or minus move. Gee, that's the better part of a Fed tightening cycle, and it comes under the we don't really know. So I come back to the idea that the Fed will do the right thing over time, but it takes time to figure out what the right thing is because we have to see the data come in. I saw a number of people saying, oh, the Fed did 50 instead of 25. What's the implication of that? We could take a look at some of the dots and just kind of put this into perspective. I wasn't surprised by the minutes because they gave us a dot plot that said, we don't agree. Some people want maybe 1 or 2 cuts this year. Some people want 4 to 5.
Yes.
Okay. Well, that's going to be a big difference. You could look at the dots and say, maybe as many as 9 people would have said, let's do 25 basis points. They're not all voters. A little inside the Fed routine, Michelle Bowman said maybe 25 is a better idea. They go alphabetically. Anybody in the voting list after Michelle might have said, I agree with you on 25, but it looks bad if we have too many dissents. So only one person dissents. And I learned that from Larry Murray's book on his time at the Fed, talking about the politics of dissenting.
Okay.
So we could look at the dots and say maybe 7 people didn't want to do 25, but they're not going to argue, because what if you do 25 more now, or you plan to do 25 basis points more in December? It's 3 months of 25 basis points. Let's talk about how much money that puts in your pocket if you're an investor. It's worth 6 cents on a 3-month bill.
Okay.
It's worth a couple of basis points on a 2-year note. It's worth less than a basis point on a 10-year note. So all of the market movements that we're seeing are really explained by economic fundamentals and the uncertainty about the future, much more than the Fed path if you take this kind of dollars in, dollars out approach. So I have always favored that for a funny reason. I like money. So if I take the numbers and I turn them into money, I can decide if I'm excited or not excited about the opportunities in the market.
And Larry, I know that you have prepared a few slides for us. So when it comes to the dot plot here, can you walk us through what you're paying attention to, what matters, and what you're seeing?
Okay. Well, we can pull the dot plot up, I guess, for the people. I guess I'll go through, like, just going to 2024, if we highlight it. I mentioned there's a lot of uncertainty in the Fed outlook. Okay. So we can see it up on the screen. Great. So 2 people wanted to have, basically, if we think of things, we started at about a 5.3% dot plot for today. For 2024 year end, we had numbers on the order of 4.8. Then we go down to 4.6, and then we get into the 4.4 category. So easily 2 people could have dissented, possibly far more if you thought, let's do 25, let's do 50 later. So all that the minutes did was confirm this uncertainty on the economic outlook in the near term for me. The longer run dots we speak to, and there we see a cluster at 3.5, a cluster at 2.9, and a cluster at 2.5. So you could easily say, gee, there's 100 basis points of uncertainty on the longer run Fed funds rate. What does that translate to for long-term rates? About 100 basis points of uncertainty. That's a big number compared to history. I have it in the packet, we needn't go to it, but if you looked at 2019, you would have had maybe 50 basis points of uncertainty. Okay. And perhaps less than that at different points in time. So the longer run dots are the Fed historically signaling the market about what they mean. And those long run dots fell from 4.2% to 2.5% and are now trending up. And part of that is, I think, just due to the models the Fed uses more than the equilibrium rate in the U.S. shifting a lot.
And of course, while we're looking at your slides right here, I do want to ask you about some of the uncertainty that you mentioned. Can you tell our viewing audience whether this uncertainty is normal?
It's a little bit more than normal. As I'd mentioned, if I looked to 2019, the Fed had projected basically an unchanged, very little change to the Fed funds rate through the whole forecast cycle, 3 or 4 years. Okay. Nothing happening, don't worry, everything's normal. And how much uncertainty was there in the long run dot plot? About 50 basis points. And that comes into uncertainty as to what long run GDP is going to be. Everybody on the Fed forecasts they're going to get the 2% inflation target, right? You don't forecast, my job is to get 2% inflation, and then forecast, I am going to fail at my job, right? You're going to forecast that you're going to be successful. So all of the noise in the Fed forecast tends to be, in the long run forecasts, tends to be in just what is the growth rate for the economy. The honest answer is we really can't be sure, and it does change over time. But we can look for relationships that give us I think, a better long-term view of what the market is going to focus on and what the equilibrium rate outlook should be. But even when you have equilibrium, one of my favorite charts historically is every month 10-year note yields tend to move 30 basis points for some reason or other. Every year they can move 100 basis points for some reason or other. If you look at the newspaper, they might say, look who has the best forecast in January. Look who has the worst. And in December, they flipped. Why did they flip? Forecasting is hard.
Yes.
And there's a lot of noise in the data that flips things about. There was an old interview question. To get next year's newspaper, what do you look for? The great answer was not the stock that went up the most. It's look at the stock with the biggest difference between the high and the low. Right? So you want to think about what range is potentially correct. And as has been said, markets can be irrational longer than you can be solvent. So you really have to look at the risk profile, in my view. When we last met, it felt like yields were pretty low. We had that 100 basis point rate move, and we've had a pretty good reversal. Maybe it gets to be more interesting. We know the Fed is cutting. We know they're looking to cut order of magnitude 100 basis points this year and 100 basis points next year. That gets them pretty close to neutral. And so when is neutral fully priced in? You don't have much upside. When are you pricing in a less accommodative policy, maybe an uptick in growth? That's your opportunity to say yields seem to be too high. My favorite economist tends to be Robert Shiller. He came up with irrational exuberance and the housing crisis, and the most recent book I've seen is Markets Focused on Themes, Not Facts. So I'll focus on themes and sort of broad-based data. I'm not smart enough to get every day correct.
Well, Larry, we've walked through the dot plots, and I do want to ask you about some of the terms that you mentioned when it comes to the economy. But before we do, I do want to ask you about what we're seeing in the 10-year yield, because since you last came on and now we're looking at levels above the 4%, can you walk us through what has happened and why we've been seeing this?
Sure. And for people who don't memorize this, we can bring up a chart perhaps. All right. And if we have that up, I'll just talk assuming we've got it. If I look at the chart at the start or at the end of 2023, 10-year yields were 4.85%. And the market theme was higher for longer, right? There's a little bit of easing versus a 5.3% or so Fed funds rate built into the long-term inversion of the curve. Then we had some slowdown in the economic data, a little bit of a peak in what's happening, and wow, the market rallied over 100 basis points on the 10-year note yield. But I won't say that's as good as it gets. That's pretty darn good. So you went from taking Fed policy away from day to day, what are they going to do, to where are we going to land? We were landing in inflation stays high forever and the Fed has to really lean on the brake for a prolonged period of time. We'll see that inflation can stay high for a period of time longer than people thought transient meant, but it doesn't stay high forever if the Fed wants to lower it. At the other end, we got that low drop in yields. Okay, that was pretty much as good as it gets for the positive story in my view. And then that reversed as, gee, that spat of economic data that implied the Fed should ease reversed. To me, this is that understand how markets and data behave. If you're pricing in everything good in the economy, or everything bad if you're a bond guy, has to get much worse for yields to fall. When you price in, gee, the Fed is only going to ease 50 or 100 basis points before the carry on the 10-year note is meaningfully above the long-run earnings from holding cash, there's money to be put to work in the long end of the market. And we've had this second reversal going from, say, 4.7 to 3.7. That's another big move, and it seemed to be about as good as it gets to this model. Now, if the data showed the economy slowing, you could have seen yields drop from that 3.7% level. But how long does it take to be sure the economy's slowing? 3 to 6 months of data. And you can see that in the price action. So given the outlook today, we're kind of saying, okay, we're getting closer to fair value. We're looking at this kind of a choppy environment, and the outlook is different than it was in May, right? Remember, the Fed put in a lot more easing at the September meeting, so we probably shouldn't retreat to the yields that we saw in May. It'd be nice if we did. It's probably a good buying opportunity, but maybe we get some consolidation between here and say 4.2, 4.3% on the 10-year note. We'll see how that plays out over time, but that's the way I would think of it today. And we can see a difference in other markets and how they behave, which I think is kind of a fun story too.
Of course. So we do have a slide here for the S&P 500 as well. So let's take a look at that and tell us why you think it's important to compare this to what we've been seeing with bonds.
Sure. Well, the S&P 500 chart, if you remember, bonds had a big rally in early 2024 and then traded off. And what did stocks do? They went up happy as could be. Well, that's a pretty big divergence. So something was inconsistent between how the bond market was behaving and how equities were behaving. Now, you might say because the Fed's going to ease, equities are going to be fine. But if we take a longer term perspective, equities had dropped a lot from their recent peak and then were rallying back up. So in 2023, equities were hitting sort of the lower end of a trend line and had room to move up. So that, I think, really that valuation story explains part of this move up. Remember, the previous high for the S&P was, well above, like 20% or more above the start, the lower levels in late 23.
And the chart that you're referencing right now is S&P 500 index that's dating back to 2015.
And I put it at 100 just to make it easier, because I can't do subtraction and division well in my head. But we can see that the recent drop, or that drop in early 2023, 24, was pretty significant. So in my mind, I'm drawing a line along here. Oh, that's not quite where I would put the line. I'd probably take it up a bit, but we'll leave that be and just say if we look at the lower end of the line, maybe it's at that trend. The 200 line that you see in 2022, 2023 should be going up 7% or more a year. So we should be thinking today at a number around 2020 is the lower end of that line. And the upper end of that line is meaningfully above it today. Now, if I look at the two peaks, well, the peaks are implying about a 7% trend return in equity prices too. So it becomes, it's really hard to bet against equities in the long run. Even if you make a mistake, you're going to earn 7% over the next decade.
And that's not a bad problem to have, is it?
Yeah, but it's an even better problem to say if I buy the low, I can make 30% in the next year or 20%, and that's the debate that professional investors are having and professional traders. But always it's a case of it's really hard to bet against U.S. equities because they've tended to do well. Maybe things will change. They've benefited from low taxes. They've benefited from an increasing share of profits as a percent of GDP. So if you say, gee, we're going to come in and change the tax code, I could say equities have a pretty potential correction to them. But you look at the politics in the U.S. and I don't see it changing within the horizon that investors are going to pay attention to.
And Larry, you do bring up an important point, because given all the volatility, or despite all the volatility that we have seen in 2024 when it comes to the S&P 500, the Dow Industrials, the NASDAQ Composite Index, even the Russell Index, we're seeing considerable year-to-date gains as we head into the final months of this year.
Yes, and it's always hard to say here's a point where the market is going to correct. Sometimes you can look and say here are the storm clouds in the economy that we really should look about, right? Maybe there's a little bit of an AI bubble. I thought there was an internet bubble. I was told for a year, 2 years or more, I didn't know what I was talking about. Ultimately, a sock puppet was not a good investment.
Yes.
To go to, was it pets.com?
Yes. Yeah.
But, do you really want to fight that trend? It's interesting to say, is it an AI bubble? There were several Nobel Prizes given for AI in science.
Yes.
But to an extent, I think we've harnessed the computer power that can look at enormous amounts of things. But if you try talking to an AI chatbot, you're like, I really hate this company that has me talking to an AI chatbot, or at least I come to that conclusion. So we'll see how it all plays out. But for now, we're in a fairly benign economic environment. If we were talking in 2006 or so, when the Fed was finishing up a tightening cycle, I could say, gee, I'm worried about housing. If we were talking at the end of the 2000 cycle, I could say, gee, I'm worried about the internet and equity bubbles.
Yeah.
Turns out there were other things that kicked in, right? There was the accounting scandals, which I think was a big piece of the early 2000s component. When you came to housing, there was a lot of talk of it was the further you dropped, the higher you bounced. But when they tightened up home loans, a lot of my stuff is very micro, bottom up. When they took the FICA for a home loan from 620 to 720, they cut out 35% of the people who could buy a home in 2006. Oh, it's going to take a while for housing to recover. That was the lower for longer phase for the Fed. Right now, there's, in my own mind, a debate of how should I look at the market in the long term? Can I identify what would be a really attractive level for bond yields? Can I find a tool that gives me an insight? Because bond yields have been 20%, or bill yields. They've been 0% in the past 30 or so years. Can I find a model that gives me an idea of where are we today in that trade-off? The answer is in the long run it's hard, but I can make a guess at something and look at some relationships.
Sure.
And a lot of the economic models are based on, gee, you got a PhD in econometrics. If somebody says history doesn't matter, econometrics uses history to produce the future forecasts. Nobody wants bad, back data to be bad. But maybe it is. We've gone through how many different Fed regimes? Lower for longer, average inflation targeting, inflation fighting. We'll do the right thing. Right, look at the noise today. The policy to me is we'll do the right thing as the data evolves. We don't really know what's going to happen. But don't worry, we'll do the right thing. Now, if I look at things from a bottom-up perspective, I can think about what investments can I make. I can buy bills, I can buy bonds, I can buy equities. If I think about what drives the economy, it's wages, consumption, investment returns. So, to my mind, if I think about this from a finance perspective, you can buy GDP, which is everything in the economy, or you can buy bonds. Just as a thought experiment. Now, bonds are riskless. So if bonds give you the same return as everything in the economy, you probably ought to buy bonds. If bonds give you a low return relative to everything in the economy, the answer is it depends. So if we go to the chart that I made, I have sort of different periods, which is humbling.
Yeah, we'll bring up that chart right now.
Okay. So if we look, I've got two different colors in this chart and a lot of history. I'm going back to the 1940s, 1950s. And the reason is nothing that we hear seems to hold up to a 50 or 100-year history.
Yes.
Because things change. So you want to be aware that things change. But recently, since Volcker, the idea that I started with was, if I can get a bond return comparable to nominal GDP and, big and, inflation is controlled, then bonds look pretty good. And when did we see bill yields, in this case, get up to nominal GDP? Well, the early 80s, 1990. Okay, we're close and zigzagging in the 2000s. Was GDP 6%, or I'm sorry, in the 90s, GDP in the 5 to 6% range. And then when we hit the housing crisis in 2009, 2010, part of that GDP spike that we might see above 5% was payback for the GDP trough. So we had a payback period, maybe I shouldn't be using 6%, maybe 5% was a pretty good guess for that period. Look at that long period of zero rates. And now what is the Fed forecasting? 2% growth, 2% inflation, plus or minus a little bit on the growth. We had very high inflation. So you might say, well, maybe we should be above that 4% trend line. Because good God, GDP is running 15. And nobody knows what it's going to be. It's like, to me, that it's impossible to call the top at that point in time. But you could, I think, call the equilibrium if the Fed's going to be successful. So I would love yields to go back to 5% given this modeling, because you'd be well above what people think trend GDP could be. And that says something's really expensive and bonds are cheap, most likely. So this is like the model. I used the early period just to say, what was different then? Well, one thing is, there wasn't a bond market. The Treasury controlled interest rates in the 50s until 1953. You had inflation hit close to 20%, and it came down without the Fed or the Treasury doing anything funny. So if I look at the history, peaks in GDP, peaks in inflation,
why don't we bring up the inflation chart for our viewing audience as Larry walks us through this.
Okay, perfect. Thank you for that. So when the Fed said inflation is transitory, what did you think transitory meant? I thought it meant 2 years, 3 years, because I looked at this chart and I said, okay, if I look in the 1940s and the 1950s, we had inflation spikes last at least a year or more. Okay, I lived through the 1980s with the inflation spikes lasting 2 to 3 years or more before they turned. Not to say before you normalized. And even if we look at the late 80s or the late 2000s, we have the inflation spike occurring above the sort of like 3% level, above the 2.5% level respectively, and they took years to normalize. So what was different about this inflation spike? To my mind, nothing. So we should have expected, gee, inflation is spiking with COVID in 2020, 2021, 2022. Maybe it'll take a few years before it starts to turn down and is clearly going lower. That's where we are today. So the debate today is, what will the equilibrium be? Look at those longer run dots for the range. And that's giving us an idea that the equilibrium has a pretty wide range it could be going to. We don't know. But what we do know with this modeling is yields getting well above 4% in the long end of the market is probably not sustainable. Yields getting really, really low, it's hard to call the bottom.
Well,
that's
Larry,
always been the case.
Yeah, I think it was very helpful for us to take a look at these historical charts, because hindsight is 2020, and when we're only looking back a couple of years, say pre-pandemic, to see how far we have come in the decades past, we see how low inflation is now. So I think it's very helpful for the viewing audience to not only see the differences in terms of growth, inflation, but also different central bank regimes as well. So thank you so much for joining me, Larry, and for walking us through all of this
today.
Thank you
very much. It's
my pleasure. Thank you. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll be back tomorrow morning. Have a great day.